Hi, now we move to the next step, a calculation of cost of capital, WACC. In the last video, we have seen the calculation of cost of debt, what is cost of debt and all. In this video, we'll be seeing the calculation of cost of capital. A firm's weighted average cost of capital represents its blended cost of capital across all sources, including common shares, preferred shares, and debt. The cost of each type of capital is weighted by its percentage of total capital and then are all added together. This guide will provide a detailed breakdown of what WACC is, why it is used, and how to calculate it. Yes, let's move on. What is WACC used for? The weighted average cost of capital serves as a discount rate for calculating the value of a business. It's also used to evaluate investment opportunities, as WACC is considered to represent the firm's opportunity cost of capital. Thus, it is used as a hurdle rate by companies. A company will commonly use its WACC as a hurdle rate for evaluating merger and acquisitions, as well as for financial modeling of internal investment. If an investment opportunity has a lower internal rate of return than its WACC, it should not invest in the project and may choose to buy back its own shares or pay out a dividend to shareholders. WACC is used in financial modeling as a discount rate to calculate the net present value of a business. More specifically, WACC is the discount rate used when valuing the business or a project using the unlevered free cash flow approach. Another way of thinking about WACC is that it is the required rate an investor needs in order to consider investing in the business. This table slides depicts the weighted average cost of capital. Cost of equity and cost of debt, two components. Cost of equity is calculated based on the risk-free rate of return plus beta into RM minus R, that is market risk premium, or it is otherwise called as equity risk premium. And then we have to calculate the cost of debt, average yield on debt multiplied with tax shield, that is 1 minus T, interest expenses into 1 minus T, will get the cost of debt after tax. So by using kappa model, we are arriving cost of equity, and also we are finding the cost of debt. See, finally we will be finding out the weighted average cost of capital. This is the formula of weighted average cost of capital. WACC is equal to E divided by V into RE plus D divided by V into RD into 1 minus T. E represents market value of the firms, that is equity, firm's equity, that is market capitalization. D represent market value of the firm's debt. V represent total value of the capital, equity plus debt. E by V represent the percentage of capital that is equity. D by V represent the percentage of capital that is debt. RE represent the cost of equity, that is required rate of return. RD represent the cost of debt, yield to maturity on existing debt. T is equal to tax rate. So the formula is cost of equity multiplied by percentage of equity plus cost of debt into percentage of debt into 1 minus tax rate plus cost of preferred stock into percentage of preferred stock is an extended formula for WACC by adding the preference share capital. The purpose of WACC is to determine the cost of each part of the company's capital structure based on the proportion of equity, debt, and preferred stock it has. Each component has a cost to the company. The company usually pays a fixed rate of interest on its debt, usually a fixed dividend on its preferred stock. Even though a firm doesn't pay a fixed rate of return on a common equity, it does often pay cash dividend. The weighted average cost of capital is an integral part of DCF valuation model, discounted cash flow valuation model, and thus it's an important concept to understand for finance professionals, especially for investment banking, equity research, and corporate development roles. Thank you.